Welcome back to the Educated Home Buyer Live, where our goal is to help you buy right, borrow smart, and build wealth. Got a lot of news this week. The most important piece of that is Josh has actually got a new mic. He's going to sound super clear. He's going to come through so crisp, guys. But with me again, we have Mr. Josh Lewis, certified mortgage professional expert. But the big news this week, mortgage applications obviously down, but more importantly, the Fed came out today and hiked the Fed funds rate, which I'm sure at this point, 75 basis points, which was essentially what the market had expected. And, right after that, Josh, I mean, obviously we'll get your take here in just a second, but the bond market reacted positively because in their remarks coming out, they basically stated that, they're going to start to watch, what's happening with the data, right? Because there's some lagging indicators there that they're going to be, more apt to pay attention versus, just getting super hawkish on things. And the market saw that as a positive sign, until Mr. Powell came out about an hour later and actually gave remarks basically saying they are going to continue to stay aggressive unless something happens otherwise. So, Josh, let's start the show there.
Absolutely. Let's look. It's funny. I'm used to hearing this mic talk here. So your fancy new mic, Jeb, that the super chat money purchased me is throwing me off here, but we'll get used to it. So let's throw this out here. I want to see. I can make this a wee bit bigger so you guys can see this. The items in red crossed out and in blue are the changes to the statement over the last month from the last meeting. And really, the only part that we want to pay attention to is here, the last part. The committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. So that change, the markets took positively, and we saw a nice improvement. We were up a half point, which is about 1/8% in interest rates. And there was maybe 90 minutes between this being released and the press conference. And Powell comes out at the press conference and basically throws water all over that and says that they're going to err on the side of aggression, of pushing things slower, further down than they want to make sure they've killed inflation. And markets did not like that. In the grand scheme of things, my take on it, Jeb, is this is meaningless because what the big show is next week, we get CPI.
I think this Friday, the 4th.
Is it already this week? Time flies,
I think it's the 4th. I think we get CPI readings this Friday.
Okay, so with that, CPI is going to tell us. We've been saying that most likely October, November, December, which are the September or the reads from starting September forward, are going to be better. They could be a little bit better. They could be a lot better. It depends on what the current month reads are, because we have really hot reads from last year that are falling off. If we have a slight improvement on this CPI, I don't expect that we'll see much movement in terms of the market. They want to see 2 or 3 months or big moves in our favor. So we're probably likely to stay in this range. We've talked about the range, Jeb, somewhere a little over 3.9 to a little under 4.13, 4.1.
And you're talking about the 10-year.
On the 10-year. So that's about 1/4% in interest rates. And that's what we're seeing. Say a week ago, we were about 1/4% in rates. Rate sheets aren't quite that bad, but if we were just reading from the 10-year, we're about 1/4% worse than where we were last week. But the important thing is watching CPI, another month of CPI, and we'll see where we're at. We're kind of stuck at this high plateau, not higher or higher than we've been in 20 something years. But what we're looking at is people were saying, is the Fed going to pivot? Well, no, the Fed's not going to pivot. They haven't seen any data that says pivot and go a different direction. We're really seeing the Fed plateauing right now and kind of saying, okay, we're going to keep them elevated. We're likely to elevate a little bit more. So is the plateau here is a little bit higher. You had talked about the market expectations today was an 85% chance of a 75 basis point hike. We absolutely saw that.
I saw a 99% chance the last time I looked. So, okay, it was like batting 100% there at the end.
It's a big high probability, and we saw that. And right now the markets are thinking 50 basis points for next month. It could go 75, it could go 25. This is the first time in, what would you say, Jeb, 3 or 4 months that there's a little bit of uncertainty as to what the next move is. We'll have another CPI read, another PCE read, and we really just have that one more meeting the remainder of the year in December. So it's more than a month off. We're going to get 2 to 3 important reads on inflation between now and then, and we'll see what happens and where rates go from here.
Yeah, I think I mean, you hit it dead on when you said, the CPI reading. And again, you might want to confirm here while we're doing this, Josh, that I believe it's Friday. So the 4th is when that number is going to come out. Again, if that number is lower than expectations, that's actually a good thing for the market. It's really weird with regards to news, right? Good news, unemployment staying low, things like that are actually bad for interest rates, and bad news for the market is typically good for interest rates. In this case, inflation coming down is a positive thing for everyone, and in turn, interest rates should follow. If nothing else, that they shouldn't go up, right? There should be less volatility in the market at that point. And we're going to find out. We're going to find out for sure. So, something I didn't mention at the beginning of the show, just because we kind of went into things pretty quickly, but I've been reaching out to experts, in the real estate community on YouTube for the last couple of weeks, trying to get some people on the show. Tonight, we actually have someone coming on from the Maryland area, Baltimore area. It's going to be able to give us a little bit of insight on the East Coast, parts of what? Oh, Jesus, dude, you sucked that straw. That thing came through this mic like a zipper.
It's your fault. You got me this fancy mic.
So we have Todd Sachs coming on here, who's actually going to talk to us about the Baltimore market, which is close to DC, close to some of these really bustling markets out there that have been bustling over the last couple of years. Going to see what's happening there. And then we also have Shahida coming on from Atlanta market. I think that's next week or the following week. We've got some people on coming from Vegas. We've got some people coming from Portland, Oregon. Austin, Texas was supposed to be on tonight. They canceled on me kind of last minute. So we are going to have some people coming on, talking about the markets, updating you guys to keep you abreast of everything that's going on. And then I actually saw that question, and that's why I wanted to. So I did reach out. I reached out to our friend, Sir Ashley, who our show didn't work out so well with in Charlotte just because of the internet connection that night, and asked for a second chance, and no response. So he either didn't like us in the 2 minutes he had there, or
those guys can go climb a tree for all I care.
He's moved on. So with that said, Josh, what else? Where are we with the rates? Right. So you started the show by talking about we saw that improvement today right after the Fed spoke. We saw a little bit of improvement in rates, but what happened afterwards? Where are we today versus last week? Because at the moment, inventory levels continue to be, one of the things that a lot of markets are talking about here locally. Orange County, we're sitting at about 3,600 homes. In fact, coming on the show, 3,600 homes on the market today, which is a little bit less than last week, but kind of in the range where we've been for the last 4 to 6 weeks. Huntington Beach, we were at 244, which again is a little bit less than last week and more or less in the range that we've been over the last couple of weeks. So, but what are rates doing, Josh?
So I'm looking here at the Optimal Blue Mortgage Market Index. Let's just throw it up, and we can kind of roll through. Actually, it's in a different browser, so let's not throw it up. But they're reporting 7.053 is the average rate on a 30-year Fannie Freddie loan right now, and that's about right. I locked one today with a lower credit score, just barely over 700 at 7.125 with 0 points. Best qualified borrowers are 6.875, 6.99 with 0 points. So right there in that range. Higher priced lenders are quoting, 7.5. I talked to a friend of mine in another part of the country where their pricing is not sharp and competitive, a direct lender, and they were quoting 7.5 on a 30-year fixed right now. So you can see anywhere in that range. But over the last week, up 1/8 to a 1/4%. Not huge moves. We've kind of been stuck in this range. I mean, really, if you look at the Optimal Blue numbers from September 27th through now, not much of a move, about a 1/4% increase over that time. And I'd say that's about right. So stubbornly elevated. We would like to see some improvement. I would love to see consistently being able to get rates in the 6s, but your FHA and VA are going to be mid 6s. If you're not wanting to pay points. If you want to pay points, you can get those into the low 6s, but that's a pretty fairly big range for where everyone's at, but stubbornly elevated is where rates are.
And something else to keep in mind is over the next 2 months, the data, right? So in this month, we're in November now, you're going to get October data, November, you're going to get, or December, you're going to get November data, so on and so forth. So the next 3 months of data are going to read pretty poorly for a number of reasons. One, there's just less activity out there happening in the market overall. So that's going to show up in existing home sales. That's going to show up in pending home sales. But at the same time, seasonality, right? We talk about seasonality all the time. This is typically a time in the market when things slow down naturally. So that's playing a part in it. And also you're comparing it to year over year numbers this time last year. Typically, this time is a slow time in the market. The last 2 years have been abnormal when it comes to the quote unquote holiday season, because there was still quite a bit of activity, quite a bit of people buying homes, going under contract in times when I would say that it's not a hot market at all. So you're going to have, much less, activity happening now. That's going to reflect pretty poorly for those reasons, right? I mean, on top of just the natural, slowing of the market because of affordability and everything that's happening out there. So just make sure, when you get these headlines, you understand the context at which they're coming on, or which you're reading them and understanding them, just so that you can make sense of it when taking it into account if you're buying, selling, whatever you're doing at that time. So cool. So we actually have Mr. Todd Sachs. He's a little early, so I don't know if I'm going to put him on the spot by throwing him on here.
He looks ready. He looks ready to go.
He looks ready. So we're going to throw Todd up. Todd's information. We're going to see how this actually comes up on the screen. So Todd's going to be underneath this. That works out. Todd, welcome to the show. How are you, my friend?
Hey, what's going on, Jeb? Josh?
Good to see you, man. It's been a little while.
It has, buddy. I mean, there's a lot that's happened since we spoke last.
I know. I think we were in the middle of a boom, and now we're in the opposite of whatever that is, a bust, if you will, a slowdown. And we're going to talk about that in your market. But I'll give you a second here, maybe talk, plug the YouTube channel that you have. It's great. You have a podcast. I don't know if that's one and the same, but tell people where they can find you, and then we'll kind of talk a little bit here about your market and what you're seeing.
Jeb, I don't think I, have quite the channel that you do, man. I'll tell you what, you were like one of my
18,000 or
15,
whatever the number is awesome, man. Congrats.
We're very appreciative. I mean, I love doing what I do now. I mean, you were inspiration as part of that, me stepping out. You were one of my first guests. We were talking about how buyers, what they need to do to snag the houses at the time, right? I mean, it was the sellers they were commanding the show. But yeah, I mean, I'm a real estate broker here in Maryland, and I've been in the real estate industry for a very long time. From one aspect or another, I started swinging a hammer in 1989. My gosh, man, time has flown. But yeah, it's now I'm a real estate broker and handling the sales side of things, helping buyers and sellers navigate whatever market we're in. And certainly the tides have changed, and I'm looking forward to diving in. Thanks so much for having me.
No, for sure. And so I think the easy answer to your question now is what do people have to do to get their offer accepted? It's just put an offer in, right? No. Well, Josh, let's start. We came up with some questions that we thought were relative, that could help people, right? Because we're always talking about Southern California, and real estate's local. And while as much as we read national news, national headlines, and try to give people an idea of what's happening, it's never as good as boots on the ground. And you yourself, you have agents, you're running an office there with agents that are, boots on the ground, selling property. So what's happening in your market at the moment? What's going on with inventory? What's going on with, offers being accepted? Are people buying homes? That sort of thing.
Yeah, it's really, it's really slowed down a lot. I'd be lying if I said anything other than that. I think the biggest thing that we're having, guys, is that the contracts are falling through. We're seeing just a whole, other side to this business than I've really experienced before. And as a matter of fact, I mean, I just had a podcast with a real estate attorney, and I was asking him the question, do contracts really mean anything anymore? And he basically said no. And you say that very lightly, right? Because a contract is a contract, but the bottom line is the remorse that's happening. People putting in the offers, they're getting accepted. Whether it's they've gone through their contingencies where they can rightfully cancel for an inspection or something like that. But we're just seeing where they're just making stuff up, honestly, in a lot of cases, and just to get out of the contract. And the agents are basically saying, look, we've got a financing contingency in here. If you don't let them out, if your sellers don't want to let them out, we'll find a way out. So I think that's happening more than I'd like to see. And we all know that when, we have contracts that fall through, it puts it, I'm not going to say it stigmatizes a property, but it's not good. I mean, as well as I do, when a buyer's looking, or an agent, we're good agents, right? So we're going to look for this stuff, and we're going to say, hey, why did it go back on the market 2 times? And it sort of lessens the seller's position. Not all the time, but it does. But just to let month over month inventory, I mean, we're up a whopping 1.5 months of supply now on the MLS. So we're still very low as inventory, sits.
That's month over month or year over year?
We're right now at 1.5 months of inventory. Last month was about 1.37. Okay. But year over year, we're up about 17%, almost 18%. But still very low.
No, for sure. Now, Josh, I saw you about to jump in. Go ahead.
No, Todd, you said something that was important. Every state, the contracts are written differently. I was sort of shocked about 1.5 years ago. My aunt sold a house in Arizona, and they're 3 days before closing. We basically learned those contingencies in Arizona per their contract run almost till the very end of the contract, till just a few days before. How are your Maryland contracts written in any other states that you might operate in there on the East Coast?
Yeah, so Maryland is pretty much just as you mentioned. I mean, if there is a financing contingency, that's going to run almost all the way up to settlement day, because a lot of times we're seeing, the enticement is let's settle quick, right? We want to settle fast. So the buyers are saying, hey, we'll close in 2 weeks or 3 weeks or 30 days. And it really pushes the envelope all the way up to the end. But the big thing for us here is we have a lot of HOAs, homeowner associations, and condominium associations. And that really affords, the buyers to have a period of time when the documents or resale certificate and documents are forwarded to the new buyer, where they can actually review that and cancel for whatever reason. So, there are quite a few outs.
No, good. And so are you dealing, Todd, mostly with existing home sales, or is this new home sales, or do you have new construction? What's the primary bulk of property that is available?
Yeah, so most of what we do are existing home sales. I mean, we do new home sales, but I mean, right now, new home sales they're dead.
Right. Now, yeah, because here in Southern California, a lot of markets have a lot of new home sales, right? And those seem to be, based on the headlines, the ones that are taking the bigger hits, right? Because home builders aren't in the business of holding on to property. And so they're in a market that has an excess supply. Those are tend to get a little bit bigger discount because, they don't want to hold on to these things, versus existing homes. A seller that has the super low rates less inclined to take a bath on a property or just give it away, because, they're sitting in most cases pretty good depending on where they got their rates. So it's always interesting to hear that side. Now, when you have these people back out of contracts, Todd, are you seeing like big price drops in your market? Are home prices decline? I mean, what's the overall feeling? I mean, are there any price points at which people are still going above the asking price, or, maybe it's a type of property that's receiving that versus ones that aren't?
We're not seeing much over asking price. Not saying that it doesn't happen, but it's not common. What we're seeing is the exact opposite. We're seeing anywhere from 5 to 7% price decline from list price.
Okay. Now, is that from is that on all properties, like when it's priced correctly?
That's pretty much what I would consider a house that's priced correctly.
Okay. Yeah. So that's pretty considerable. When you're starting to see those numbers. Now, do you guys have seasonality in your markets this time of year? I mean, Obviously, Maryland gets snow. I don't know that it gets snow every year, but I think, depending on where you are in the state, probably get some snow a couple times a year. So does the market have a typical slowdown as we approach the end of the year? And is that a part in it, or do you think it's primarily due to affordability and what's happening in the market?
I think we're looking at right now, and we'll kind of go over, the affordability index for the Maryland area. But I think what we're seeing is purely an affordability issue right now. I think that there's plenty of buyers that would love to buy a home, but as you know, I mean, with the interest rate, I mean, our friendly Jay Powell, he didn't help us again today. I kind of feel like I wonder where they get their information or their data from. That's another story. But I think what we're seeing in a normal market, yes, we have typical seasonality. It may be similar to what you might experience, where you have kind of like the last push of the summer where people are vacationing. And then you have the back to school, where, people they're kind of settling. If they have kids, that they're settling their kids in the school year, they're not really looking to move.
Right.
And then obviously, as you get into the Thanksgiving and the holiday season, no one wants to move or show houses with, presents around a Christmas tree, for instance. So, I think that, yes, now we haven't seen that in the last couple of years. It really didn't matter what the season was. Inventory was going as fast as it possibly could. But but I think that what we're looking at right now, Jeb, is there are plenty of buyers. I mean, look, we're looking at limited inventory, right? And that old supply and demand, where you would say, we were arguing with appraisers saying supply and demand not that long ago because they weren't getting to the prices that we all wanted to see, right? Or that the buyers wanted to see to be able to get financing. But we were leaning on saying, hey, it's a supply and demand issue. But still, with the inventory that's out there, I think we're just the bridge is just not connected between, the price of the home and if they need a loan, the mortgage payment for, most of the buyers.
Right. So Josh, you want to jump in there?
The affordability is really the biggest piece, like what we like to talk about here. It's not willing demand, it's able demand. And everyone was able to buy the last few years with rates at all-time lows and prices at lower price points. I have a really good example. I have a client here in San Diego. They would love to buy, and they have about 10% to put down. Income obviously is what it is. We have no play in the joints there. And they've been waiting, trying to save a little bit of additional money, and they're just getting squeezed every month. So they really want to be at the $700,000 price point, and they qualify for about $650,000. And as crazy as that is, $650,000 is a lot of money. Used to be a mansion. Now it's how do I get into a decent entry level home? So that affordability weighs heavily on this. You're probably seeing the exact same thing that I see. There's no lack of people calling. They're just kind of shocked. A lot of buyers just don't really understand what the numbers look like. They have an idea in their mind. And when you quote a payment on a 7% interest rate on a $600,000 or $700,000 purchase without a large down payment, it's somewhat of a shock, and it's taking people out of the market. And it's not that they can't be qualified to buy a home. It's that they don't qualify at current price points. So there's only a couple of things that can help us remediate that. And the only one that is likely to happen in the near term future is lower interest rates. And like you were saying, Todd, what happens? What is the Fed looking at? They have put on the brakes. They have raised rates at the highest rate in history, the fastest percentage basis increase in interest rates. And we haven't had time for that to take effect and have an impact. We're going to see that. So, Jeb and I have been talking about what we're really going to see what this market looks like is in the spring, March and April, when we historically see that pickup of buyers coming into the market. We're going to see where rates are at. We're going to see where the economy is at and what consumers' preferences are and how strongly demand does or does not come back. What are your feelings on your market and what you're seeing on the other side of the country?
Well, I think nationwide, for the last several years, even before the pandemic, we were seeing that first-time buyers or millennials were making up about a third of the buyer pool, right, of the home sales. And do you guys find that to be somewhat consistent?
I think that's fairly accurate. I mean, here in Southern California, maybe a little bit less just because of price points, and we've got a lot of move-up buyers and that sort of thing. But I would say at least 25% of the buyers are probably first-time home buyer millennial. Yeah.
And I think what we have with that buyer is that they're very affected by higher priced everything, right? I mean, I know so many millennials that are financing their groceries. I mean, things are so expensive. Their gas, their financing, and these are high credit card debt, right? High borrowing debt. So, high interest rates, in other words. What the Fed is doing is directly affecting, those consumer loans, not just because we know that the Fed raising, the overnight rate doesn't directly affect the 30-year fixed mortgage. Now, it does trickle that way because it follows the treasury bills, right? The 10-year treasury, which Josh, you were mentioning earlier in the show. But I think what we're seeing here is that I don't know that just by, mortgage rates dropping down, that this is going to do very much for us. I mean, I think we have an affordability crisis like we've never seen before. I think that we have building materials that are record high. We have, Clean Air Act and, green initiatives that, as move. I'm not saying that we should poison the earth. I'm not saying that we should have bad air. But when we're looking at these lobbyists and these bills and initiatives that directly affect housing, we're talking about, eliminating fossil fuels, going to electric, and we're on the East Coast. I mean, hey, look, it gets cold here, right? So now we start looking at, utility expenses increasing. I don't know. I think what we've gotten ourselves into, and believe me, I'm not trying to be raining on any parades, but I think what we've gotten ourselves into is much bigger than, just a housing affordability issue. I think that something has to change. I don't know what it is.
Todd, for us here in California, and specifically, it varies by county, but historically, we've seen for Orange County, where Jeb and I are, 17% affordability has been a wall. We went past that in the last peak solely because you could lie and qualify for the loan. But when you actually have to qualify for the loan, 17% affordability is the peak that we get to. And there's always been some type of correction, small or large. The last one was very large, largely because we went too far beyond it. So I think you're 100% correct. As of today, buyers wanting to buy would be thrilled to hear they could get a 5% interest rate. Do 5% interest rates fix the demand issue and bring people flying back into the market? They don't, because we did see a chunk of appreciation the first half of the year. So we would still be 11% higher than we were, 10 to 12% higher than what we were at the end of last year. Rates would have gone from 3 to 5%. So you got 40, 50, 60% higher interest rate there. So it doesn't solve things. It doesn't take us back. And we've talked about on the show, I don't know if you've read the book Animal Spirits, but when we get the last couple of years, like the market is like, people are, it's just like euphoria. Everyone's going to buy no matter what, throw everything out. That doesn't come back just because we return to normalcy. You won't get that momentum back. A thing that I think is important to point out, there's a lot of people that think, real estate professionals, they just always want to tell you it's always a great time to buy, always own a house. Everything is wonderful. Here's the reality. I've done this for 26 years. Jeb's done this for 20 years. I'm assuming you've also been doing this for quite a while.
I started in the housing industry in 1989, swinging a hammer. So yeah, 33 years I've been serving this industry.
A long time. If you've been doing this for a long time and you're good at your job, we will always make money. We will always succeed. Someone in my industry had said something really profound about a month or two ago. They said, here's the reality. You're going to work as hard the next year or two as you should have worked the last 2 years when deals were just falling out of the sky. All you needed was a bucket to gather business. So the flip side of that is we have low barriers to entry in both mortgage and real estate. So we had 9 billion realtors and 1 million mortgage lenders the last few years. You don't have the same thing. What you're going to have is probably 60% of the volume of business and 50% of the professionals in the business, because it's not easy to make a living. So I don't look at this, and the people that I talk to and that are in our mastermind groups, this is as much an opportunity as it is a problem. It's an issue and it's a problem for our clients. So we have to work through this and help them get into the market. People want to own homes. We talked about over the long haul, 65% plus or minus of American households choose to own their home. they still have to pick the entry point. So if the entry timing is not right in terms of affordability, where they're at, there's a tension in their life. They want to become homeowners and the market doesn't allow it, or the timing of their life. So that makes for unpleasant times. I don't like having conversations with people all the time and saying, hey, I'm sorry, homes are 650 still in your area and you qualify for 525, but that's sort of where we're at. So it's definitely a different market, a challenging market, but it's not a market to panic. It's a market to look and say, how do you utilize your expertise and knowledge to help people who the timing is right for them to get into the market or to get out of the market? And that's kind of a transition, but kind of to a question for both you and Jeb. What, like on the listing side, that's really what we're seeing. Owners are choosing not to list their properties because their option to buy much more expensive than what it could have, would have, should have been. And that interest rate, if they have financing, if they're moving up and need to borrow as much or more than what they owe on their house, that's going to be a drag for a long time. My concern is not so much for a drop in home values. It's for a drop in volume as people just choose not to transact until we get some type of normalcy on the interest rate side.
Yeah, Todd, I'm going to just jump in there real quick. So I've been saying exactly what Josh has been saying for the last couple of months. You're just going to have a lack of people willing to put their homes on the market. And I think we're seeing that, right? That's why we've seen inventory in some markets. Like you said, I mean, you've got, inventory's up 17% or 13% or whatever your number was from last month, but it's still sitting at 1.5 months of supply. So still relatively low, historically speaking. And again, granted, a lot of people are panicking just because the lack of activity in the market. But I'll tell you, I saw the other side of it. And Josh heard these conversations that, I'm talking to a client he owns the property as an investor here locally, and he's owned it for 17 years. Actually, it's been a rental for 17 years. He owned it a little bit longer than that. In fact, the same tenants were in this property the entire time. He never raised their rent one time. This is just a little bit of backstory. Not that you need to know this, but I just thought it was interesting. Never raised their rent. And so their rent was probably $700 to $800 under market value this entire time. And so when he goes to sell the property, we list it at, said price, $425,000, which quite frankly was probably a little bit above where it should have been just based on the condition of the property needing, some TLC and some love here and there. And our first offer came in at $395, right? So that's 7-8% lower than the asking price. I don't know the number right off the top of my head, 6-7%, somewhere in that ballpark. $30,000 less than the asking price. I go back to my client, granted, cash offer, 2-week close on this property. So strong offer. I've already had a conversation with the agent. I know that just based on my conversation, without him telling me, that the buyer's willing to negotiate on the price. They're willing to go up on that price. They didn't submit that price thinking that, hey, the seller's just going to accept it and move on. They went low because they thought we would come up and they could meet somewhere. Well, I tried to convey that to my client who's a seller, and he just wasn't taking, he's like, no, I'm going to take the offer as is. I'm like, listen, you're leaving money on the table here, probably $10,000 to $15,000 you're leaving on the table. Are you okay with that? And I more or less had him put it in writing in an email back and forth to me just to make sure we were on the same page, that there was no information being misunderstood in this process. And it's just because he wants to get out. He's ready to sell that property, have the cash. Now, I don't know if there's more going on the backside than what I'm willing, than what I know. But what I can tell you is that in that case, seller panic, interest rates are up. He's not seeing what he wants to see. He's willing to take a lowball offer. And now, is that the new comp in the neighborhood? Maybe. It's definitely not going to help values in that neighborhood, Todd.
Yeah, no, I definitely agree. That's the new comp. The sellers, what I'm finding is sellers are going one way or another. So they're either saying, you know what, I don't need to sell. I have a 3.25% interest rate, or no mortgage at all. And, basically they're going to wait it out. If they want to sell in the next year, I'm telling them they better sell now than later, because I'm not as optimistic. I think that this is far from over. The Fed just showed today they're not deviating from what they said. They're saying, oh, well, the Fed's going to lighten up and soften up. And I don't even know what data they're using or information they're using, to to make their decisions. But clearly they have zero problem with crashing every single market, out there with just jacking these rates up the way that they are, right? The biggest accelerated interest rate hike in I don't know how many years, right? Probably forever. Maybe back in the 70s when we had stagflation. But I think that what we're looking at here is that the sellers they're either thinking that the market's going to change and that, they'll put it on in the spring and things are going to be so much different. Or just like you said, Jeb, they're just like, oh my gosh, don't lose this deal. Please don't let them, don't let them out. They're qualified. Let's take it. I mean, what does it mean? I mean, it's a whole lot of opportunity for buyers. Now, I do want to say, I do want to touch on because, look, we're all in the business. We're professionals in the business, and we're trying to make sense of what's going on. Nobody has a crystal ball, but I think the biggest thing that people are thinking right now is that these sellers are just going to discount the house 50% and take a half price offer on a house. I don't see that happening. I think that, yes, we're going to see price corrections across the market. And maybe in some markets, we'll see 20 or 30% on those overinflated markets. But I don't think we're going to see in Maryland. I think, 5 to 7% is pretty significant. Maybe we'll see 10 or 15%. I don't know. I don't think we're going to see. What was it, Jeb, back in the crash? Was it nationwide an average of 27.5%? I think.
Yeah, I mean, some markets here locally. I mean, Josh, I owned a house at that time that I bought for 1.6. It ended up selling for 950, 975. So I mean, some upwards of 50% in some of these markets.
So the first house I flipped in 2008, the gentleman had bought it less than 3 years before for 665. We bought it for 265.
Was it distressed?
It was significantly distressed, and we bought it at a trustee sale. We didn't buy it from him. So to that point, I don't know how good of data you have for your market and markets around there, but we have some really good data. There's a gentleman that's been tracking this and following. Every time we have seen a large scale downturn in values, at least 40% of the volume of homes listed for sale in the MLS were bank owned. So homeowners,
that you're going to see at 50%.
Homeowners don't choose to discount their home. They have to get to a position where they are losing that property, and a bank gets it. The bank is like a builder. We talked earlier in the show. Builders are, if they have 100 homes, they got to sell 100 homes. They can't sit there and hold them. They could possibly sell them to one of these hedge funds to turn them into rentals, but they're going to sell one way or the other. Banks are the same way. They're the ones that will liquidate at any price because they were not set up to hold those. But the big difference between the last downturn and any other downturn before that is we're sitting on more nested equity than we've ever seen at lower interest rates than we've ever seen. So we've talked about home prices being sticky to the upside. And the reason for that is people want to remain homeowners. And when the alternative is so unattractive relative to that, if you lose your home in the current market, you are likely to pay more in rent for an inferior property than owning. Doesn't mean that no one's ever going to lose their home. It means they're going to beg, borrow, steal, fight, scratch, and claw to make sure that that doesn't happen. Unlike the last downturn when people had lied about their income, couldn't afford the monthly payment, and put no money down. And the only thing they were risking when they walked away was their credit score. It's just a very vastly different situation. So, what are we talking about? From prior to the pandemic to the peak, we hit about 35, 40% increases. If you look at a linear trend back to the lows in 2009, 2010, wherever you measure it, and you go back in time of what a linear housing price trend looks like, we really hit in the last 12 months being above trend. Now, when we correct, we usually correct below trend. So it tells you, you can look at that and project where a number is. We don't have a recipe for a massive downturn in values. And for the most part, it will be dictated by what happens with interest rates, because that will tell us, do we get a stabilizing amount of buyers into the market, or do the prices have to come down to stabilize the market? It's going to be a lower volume any way we look at it, because like you said earlier, a 5% interest rate doesn't bring buyers flooding into the market. It brings more of them, but it's not like what we saw the last 2 years. It's important for everyone, realtors, mortgage people, buyers, sellers to know that's an anomaly. Like, I don't know that we'll ever see a market like that again. We always say that, we saw it in 2004, 2005 with a super crazy market with people lining up to buy homes. And then again, what do we see? 17, 18 years later, we see another crazy market like that. So it's possible it could happen again, but I wouldn't count on ever seeing it again. That was a crazy, insane market. So just throw that out of your memory and say, take 2004 to 2008, throw it out of your memory on the good side and the bad side. And what did the last 15 out of the last 20 years look like? That's more what we should expect going forward. And there absolutely could be a correction in the near term, but the affordability equation is going to go a long ways towards dictating that, because we're not going to have the forced sales that we had in the last downturn.
No, I agree. Now, Todd, who is your typical buyer? You said a third of the buyers were millennials, so obviously those people are getting affected. But obviously you had some move-up buyers, right? Some people that were selling, moving up. Do you have a bunch of investors in your market? Do you have second home buyers? Like, who's the bread and butter when it comes to transactions there?
Yeah, I think as a matter of fact, I was just looking at some stats earlier, and we see all backward-looking data, right? I mean, it's, you look at it, if we were stockbrokers, we could, pull up the computer and see what something's trading in real time, right? But a lot of what we look at, I mean, we're stuck with, waiting for, the National Association of Realtors or our state association of Realtors to compile all the data and then feed it to us. But really looking at the peak here somewhere around May, or really if we look back at like Q1, about 17% or 16.5% or so were investors here in the Baltimore market, right? So not like areas of Texas where double were investors, right? But that was still up from a year ago of like 12% being investors. So most of our buyers are first-time buyers. And then I would say we do have a pretty significant amount of move-up buyers. Maybe they're selling a townhome and they're buying a detached home. And then, of course, we have the aging population. We're a big condo area. We serve 9 markets here in Maryland and 9 different counties surrounding DC and Baltimore. And we have a lot of condominium and 55 plus communities. So we do have a fair amount of, downsizers as well. So, I mean, we have a pretty large gamut. We're a transient state in certain spots because of our military. The government is big here. Insurance is a big employer here in Maryland. So we do have, a lot of stabilized incomes and, a lot of everything really. But our first-time buyers are crushed right now.
No, understood. And I get it. Now, did you have a lot of cash offers in the height of the market? Are you still seeing cash offers? Because it's surprising how many cash offers, obviously number of transactions is down, but I mean, the last 3 transactions that I've been involved in have been cash offers, right? Had some clients come in from Canada looking to purchase around 1.1 million, just over 1.1, 1,150,000, all cash. This property that I just put into escrow, the one we talked about a moment ago, all cash transaction. And I just sold one here in South County at 1.3 million, 1,295,000, and that's all cash. Like, it's crazy the amount of cash still out there in the market. Do you have that sort of thing in your market as well, or is it mostly financing?
Most of our cash sales, from my experience, have been people from out of state. I mean, I just settled one last week, they moved from New Jersey to Maryland and they were cash. And then I just had today I had a settlement from someone that moved from Colorado to Maryland and they paid cash. And we're talking about substantial purchase prices. So, there's still a lot of cash. I think that we did see a lot of it when people were selling the home that they had been in for 20, 25 years with very little. If they had a mortgage, it was very low. So they were able to downsize in a lot of cases and buy a condo or something like that for cash. But we're seeing a lot less of it than we're just seeing a lot less transactions.
No, I get it.
All around.
Now, where are the opportunities? We'll kind of just finish it up here. I mean, because I think we got to, you can obviously stay and we can take some questions or whatever, but with regards to talking about markets, where are the opportunities in your market? Are they on every type of property? Are they on specific properties? And I'll give you an example. In our market, the turnkey properties, the ones that are nicely fixed up, that are priced right, kind of HGTV style properties, still sell at the asking price, pretty close, some above, whatever. The ones that are sitting on the market longer are the ones that's got that need some work, need some love, maybe inferior locations. Maybe the buyers just don't have the money to come in and do those properties, and they're looking to buy. They want the property already fixed up because they don't want to live in that type of property or that condition of property for while they save money. Is that similar, or are you seeing it's everything is in a similar position?
If the property needs work, we're seeing the properties just sit. Unless the sellers are really, we have, a couple we're negotiating right now where, the home inspectors went in and tore the place apart, right? Literally, you're looking at 50, 60-year-old houses. They literally tore the place apart. The buyers want everything, not, well, it'd be nice if we had this or this or this. They're listing everything. You're seeing multiple pages to the property inspections notice where, they're just listing everything. I think similar to what you just said, if it's a property that is in pristine condition and it shows well, and the agent does a really remarkable job of launching that property. And I'm not talking about cell phone photos. And people give me a hard time. They're like, oh yeah, like pictures matter. They do. When people are sitting, when that property hits the market and they're at 2:00 in the morning while the agent's asleep and the buyers are there with their laptop looking at the property and determining whether they want to see it or not, it matters. Having everything filled out right. If it's in a great location with a great lot and everything is great, yeah, we're seeing activity and even multiple offers still on properties like that. But the sellers have to realize that that's what it takes. So they have to listen to the professionals now more than ever. They can't just throw their hands up in the air and say, well, I've lived here 25 years and it's been broken ever since, and I'm not fixing it. If they have that attitude, it's going to sit, or they're going to take a hit, big hit on price.
Let me piggyback on top of that for both of you guys, because I have a different perspective. We talk to a lot of realtors, and not necessarily just realtors that we're partners with. We have a unique program that is only eligible for 6 Southern California counties, 8 Southern California counties. 7 of those 8 counties are very expensive, and it's only for high balance and above loans. You got to be above $650,000. So any way you cut it, that's an expensive loan, an expensive property. And when we go through and the person says, oh, that sounds awesome, can you send me a financing flyer for your property? I have a system where we just plug in the MLS number and it pulls up the property. And this week I was stunned by 7 to 10 of those properties that were anywhere from 800 to $1.2 million. And I look at it and I go, this house is horrible. And you can't, as an agent, you can't do anything about that. You can advise your client to improve it, fix it up. But what blew my mind is almost all of these didn't have professional photos. There wasn't a minimal cleanup done. So I know, Jeb, I know my other professional realtors, if you have a listing that is not going to be easy to move, both of you guys, what do you do in that situation? Because I was kind of blown away. I'm like, I can send you a flyer. I could send you a flyer that says I could do a 2% loan on this. No one's buying that house, no matter what kind of financing I can offer, because there are other homes in the neighborhood for $25,000 more that have $200,000 of improvements done to it. What do you do if you have someone come to you with a home that has horrific deferred maintenance beyond having professional pictures and doing as much as you can to present it as well as possible?
Todd, you want it, or you want?
Yeah.
Go ahead.
Well, I think I'd like to know what you have to say as well. But, as far as, I had an agent not that long ago was trying to sell. They came to our brokerage and they were trying to sell this particular property. It was a dump. It was in bad shape. And there were 3 photos, right? Because the agent at the point was like, well, why do I want to photograph all the stuff? They're like hoarders. Why do I want to put it in there at all? And I said, well, I could tell you why. As a real estate investor, I don't want to waste my time going out to a property and seeing something where the agent has 3 photos But if I have all the photos, even a 3D tour, and I can zoom in and I can look at it, I can sit at my computer and say, yeah, it's not really that bad. Yeah, there are all these things, it's a mess, it's a dump, it looks like it needs a lot of love, but I'm able to sit at my computer with the technology today and really examine that place, and I can still get excited about it. So I think that, for anybody that's listening, that's a seller, it's very critical that you put it out there regardless. But I think it comes down to managing expectations. So, if you're a professional and you're meeting a seller that is in this situation, you have to find out, are they willing to do anything? Because I don't want to push somebody into something that they can't or are just flat out unwilling to do. And then we adjust accordingly. And, I've sold properties where, the family is taken over because the last parent died, and the place is a mess and they don't want to move anything. They don't want to take the trash out. It's like, hey, that's okay. If that's the case, I can either make a decision to do it myself, right? Or we can have a conversation to where we can just present it for what it is, and then target the buyer, really pick, anybody could buy it, obviously, but if in that case it's more of an investor sale, we just need to be prepared for that.
So your marketing would look somewhat like a wholesaler's marketing to investors, saying, here's what the after repaired values are in the neighborhood. Here's kind of an estimate of what it would look like. Here's what it would take when the plumbing was last done, any electrical, roofing, windows, that type of stuff, and inform the buyer as much as possible.
And I'd be transparent, so if it were, hey, look, maybe a home buyer that's going to live there, occupy the home, would buy it. But I think it's a matter of managing expectations. Can you get a FHA loan? Can you get a VA loan? I mean, now look, if they can't, why waste a bunch of time, right? If the seller's not going to fix anything and you need $10,000 in repairs in order to get financing, we need to be upfront about it, transparent about it. And, it's communication, we need to talk about it. And I think that's what we do, right, Jeb?
No, 100%. You nailed it when you said you've got to be, I don't know the exact word here because I started thinking about something else, but you got to be upfront and honest about the property. Beating around the bush, not giving people, the reality because you're afraid you won't get the listing or whatever is not, in my opinion, not the right way to approach it. It's better to be transparent up front and say, hey, listen, this is what I would suggest you do with a property. Like I have one right now that's a $2 million property that it's going to be listed. I had a conversation with her today. When I walked through the property, I said, listen, we can sell it like it is now, but you're going to get less money, significantly less money, because there's just so much stuff here. It just doesn't show well. And the photos is while we're going to do professional photos and we're going to make it look big and open and whatever, it's still not going to show to its potential because of the stuff that you have going on here. So let's take some time and get the stuff out of here, declutter it. She's moving across the country anyway. It's one of those situations where she's not in a rush. And we've talked about it. Hey, listen, we know what the market's doing now. We don't know what the market's going to be doing in 2 to 3 months, right? It could be less. But what I can tell you is that by waiting, even if the market corrects a little bit more, you are still going to get more money by waiting than selling the property in this condition, because there's too much there. And your buyer is somebody coming in, looking at this property saying, I need to, it's a gut or whatever, versus seeing the potential of the property that's there. And in this case, it's not a gut by any means, but it's more just talking through it. It's, a professional's market, right? I mean, I mentioned this earlier in previous streams where, there's this little meme going around that said 91% of agents haven't sold in a market where the days on market were above 45 days on market. And what was the other piece of it, Josh? I forget what the thing was, but it was like something crazy. Like, what do you mean they haven't sold in a market where days on the market were over 45 days? There was some other piece to it, but it's pretty surprising to listen to it and go, wow, the majority of agents out there have never been in a professional's market, right? And so now it's more, make sure you're working with a pro. And that sounds like I'm tooting my horn here, or I'm tooting Todd's horn or whatever. It's the reality. It's homes are still going to sell. People are still going to buy property, maybe not at the prices they did. People have to, there's always transactions in every single market. There's always opportunities in every single market. You just got to know what you're looking for and buy when it's right for you.
Hey,
Again,
Jeb,
Yep.
I'm sorry. Jeb, do you remember the days when, listing agreements are a year and you have to renew the listing agreement?
Oh, absolutely. Yeah. I mean,
you're like, you've been on the market for a year, and look, and then you're telling the sellers like, hey, you got to keep this in like showroom condition.
The last listing agreement I just got signed was a year listing agreement. I haven't done one of those in easily 3 or 4 years, easily, just because you didn't need to.
Yeah.
And so, it's changing. So we actually had a question. Josh, did you have a question or a comment?
It was a comment and I lost it. I guess what I was going to say is you had mentioned earlier in the year, Jeb, that one of your mentors had said, hey, the first half of the year is going to be a lot like the last couple of years. And by the end of the year, we're going to transition to a professionals market. And I got it at the time. I understood what you were saying, but I understand it more now, seeing the cost of working with someone who is not an expert, who doesn't understand how to operate in this market and is afraid of you as a client. We've always talked about, people will ask, should I go with this guy? He's willing to discount, $5,000 on his commission. I said, well, if you can win a negotiation with your realtor, fire that realtor and go get one, because that is where they're protecting your value in the negotiations with a buyer. And it's different. The last 2 years were, how do we not overpay? How do we not give up too many of our contingencies? Now it's, how do we save as a seller? How do we save as much of your equity as possible and present that home as well as you can? One of my mentors is really famous for popularizing 80-20 for business. And about 10 years ago, he said it's fractal. So it's 80-20 of the 80-20. So you're really talking about the best of realtors and mortgage people are that top 4 or 5%. And I don't mean that by looking up the rankings and saying who did the absolute most number of loans. In our industry, there's 2 guys that did over $1 billion of loans last year. I don't think that person can give you the level of service that someone that did 100 million of loans can. But there's a sweet spot there of experience, knowledge, expertise, and being able to give you that service. And this is where on the real estate side, you guys are going to have the opportunity to differentiate yourself from people that haven't been through a tough market.
No, good stuff. Now, quick question, Todd. Sussex County, Southern Delaware, is that a market you serve? Do you know what's happening there at all? Bill?
I don't.
Okay. Yeah. So sorry, Bill. Can't help you there. What I'd like to ask, though, guys, while you're listening to this, I mean, Todd, hell, you can put it in there too if you'd like. I've reached out to areas like Atlanta. We got Tampa Bay coming on. We've got, like I said, Vegas. We've got Austin at some point. Eventually, we got Portland, Oregon. So some of these popular markets, right? We need a Boise expert. If you want to hear from an expert in a market or an area, and in some rural, don't give me Kinston.
If you're
North
in a
Carolina,
tiny
right?
market, don't suggest that.
If you're from where I'm from in Kinston, North Carolina, we're not going to have an agent on from Kinston, right? Give me a densely populated area where we can get a pro on that can talk about that market as well as the surrounding markets, because I think this is helpful. You know what's going on here in Southern California because we talk about it every week, but you don't know what's happening in Baltimore, surrounding areas, DC, Northern Virginia areas. And that's where an expert like Todd coming in can give you a little bit more information on that. So let us know
Jeb,
in the chat where you want to hear people from. Yeah.
Jeb,
Todd.
I might be able to pull up the data. Our MLS does cover that area. I don't know if
it's all good. I mean,
was.
I'd more so like, data's one thing. And that's the thing is like, but a feel for what's happening in the market, right? I mean, you can look at some of the data in our market. A perfect example, right? I've said this example, and I'm not cheerleading housing, but you take my community, for example. At the moment, there's a couple of houses listed in there. They're overpriced based on the peak values, right? If we took the peak in May, you could say it's May, say it's March, whatever your number is, these things are $200,000 priced above that peak. And I'm telling you, it's not priced right. It's not, if you sold it back then, it wasn't priced right. It was overpriced. So, looking at data sometimes can be, it can be accurate. And sometimes it can be like, okay, I know for a fact that wasn't correct. So even when that data closes and it shows that it closed for significantly less, that's going to look really, really negative on the market when in fact it wasn't that negative to begin with. It was just a mispriced house to start. So,
This is
that's
true.
all. Yeah. So,
Yeah.
but that's every market. Now, I told you I'd keep you for 30 minutes. You've been on for 45. You want to stay, you want to go. It's up to you, buddy. Either way, you're
It's up to
good to
you,
go.
brother.
No, hey,
Look,
listen, we're gonna just start talking to some questions here and keep going. At any point you want out, just you can say adios or what have you. But I'll let you kind of plug or just so you guys listening, Todd's information's below, his channel's below. I know he also runs a podcast simultaneous to the YouTube channel, a lot like Josh and I do. Now, is your podcast, Todd, is it the same stuff that you do on YouTube, or is it separate? Is it some of the same?
Man, you're talking about my audio podcast. I mean, it's, we need to be better at that, man. So we have been extracting the audio and sticking it on Spotify and Stitcher and Pandora and all the channels. But YouTube is really, I guess, what we have been the most true to because we do show a lot of data, a lot of slides, some things that we've created and things that we found. But yeah, we, definitely would love to have any of your audience check us out, and we appreciate it, Jeb. And look, you and I have done this a couple times before, and I got to tell you, I mean, it's great what you guys do. It's a quality show, and you're professionals, and it's always nice to connect. And we're coast to coast, man, right? I mean,
we got it covered. So let's start back up at the beginning here. We got some questions that we flagged. Some of these are early in the show. Don't know if these people are here, but we're going to talk about them. And so the first one is coming from Orange Pulp. Last weekend, went to an open house, told the realtor I was interested, and she said, well, they accepted an offer, but give me your info in case their financing falls through. Is this normal? Sure. I think so. I mean, I think in this environment, agents are looking for backup opportunities, right? Most agents that are open houses, in my opinion, are there to get business to start with, right? They're not there to sell the house in many cases. They're there to meet new clients, to meet the neighbors, to meet potential listings, buyers, what have you. But in a market like this, financing, I mean, you heard Todd say at the beginning of the show, if you were here, that they're having a lot of cancellations in their market. So this is an opportunity. Somebody falls out of escrow. There's an opportunity to go into escrow. But you might not have that opportunity without, the agent being able to contact you up front. And plus that's a win for them too, right? So they get the opportunity to maybe make that sell, or maybe you find out before that deal falls through and get an opportunity before somebody else comes in. So I wouldn't say it's abnormal. I would say in the last couple of years when there were 50 offers on a house, an agent didn't care what your name and number was. Now they actually do. So,
and I don't think, Jeb, from in case the financing falls through, it's really more like what Todd was talking about earlier in the show. Yeah. Any contingency that you could fall back on, because from our end, we do our due diligence on the front end. We never have financing fall apart on someone in process. Does it happen with other people? Yeah, it does. But I don't know that that's all that common or anything more common in the current market. It's just that the financing contingency is a way to back out. And I certainly see buyers being more selective. I had a buyer yesterday. He's 10 days into a transaction. He sends me a text that says, how much do I owe you for the appraisal if we back out? I said, $700. Why? He says, well, we're going back and forth on some repairs. I don't know that the seller's going to give them to us. I said, well, cool your jets till the end of the day. A year ago, I'm pretty sure the seller would have told you to pound sand. In the current market, I don't know when they have, I knew from talking to the listing agent when we submitted our offer that they have a property they need to close on in 30 days. They're not going to lose it over a couple $1,000s of repairs. And sure enough, they came back later in the day. But the point of the story was that he was willing to walk over it. And a year ago, buyers weren't willing to walk over anything. You could tell them that there was a pit to hell in the middle of the kitchen. They'd go, we'll work around it.
Yeah. So, but something I forgot to mention a moment ago, if you're finding any value tonight, hit the thumbs up. There's 322 people listening at the moment, only 70 likes. So, show some love there, show some support. Show Todd that you actually like him on here. Otherwise, you're offending Todd if you don't like the show. And then on top of that, let us know where you're listening from. Do we have any people from Todd's market out here on the East Coast? I'd be interested. So let us know in the chat where you're listening from. City, state would be helpful. And then we'll put a little interactive map up at the end, and you guys can see where everybody's located. So Todd, we're going to jump into another question here. What are your thoughts on a home buyer assuming a home seller's mortgage to keep the seller's low rate? So Josh, I'm actually going to throw that to you because it's more of a financing question than anything else.
Yeah, it doesn't come up very often, largely because home prices are so appreciated that conventional loans, for the most part, are not assumable. FHA and VA are, but at that, you would have to bring in so much money to put down that very few people have that. If we look back to the early 80s, when that was really popular, assuming loans, due on sale clauses were not put into loans by then or at that time, and purchase prices were much, much lower, and second mortgages were more popular. So someone would get a second mortgage, they put 10% down, get a second mortgage for 30%, and then assume that 60% first mortgage at a lower rate. We don't really have that recipe in the current market. Todd, is that something you're seeing people even ask about, or sellers say, hey, I've got this great rate, is there anything we can leverage to try to have someone assume my loan?
And you know what I'm hearing, which is just completely blows me away, but subject to is starting to become a term that we're hearing. And I know a lot of agents that are, I mean, I can't believe it, but they're taking these courses on subject to, and they think that, and there is a due on sale clause that I've spoken with a couple attorneys about it, and they say that as long as the bank's getting paid, you know, they may be okay with it. I mean, Josh, you're the finance guy. What do you think about subject to? And just so everybody knows what it is, basically, somebody enters a contract to buy the house and they keep the current mortgage intact, right? They just they make the payments for the borrower.
So it's basically assuming a loan that the lender is not allowing you to assume. So lenders are not dumb. They track this. They're tracking who is the owner of record and what happens with title changes. And you can take your home and put it into a trust, and that doesn't trigger the due on sale clause. If you take your home and put it in my name, it triggers the due on sale clause. So now the question is, are they actually going to enforce the due on sale clause? Probably 99.9% of the time they will not, as long as you make the payments. They will foreclose very quickly under the due on sale clause if you miss even a single payment. So in all of my years of experience, I've bought 3 or 4 homes subject to, never with the intention of holding long-term. It was with the intention of renovating and reselling. They had a good loan on it. It was cheaper than a hard money loan. We made a down payment, kept that in place with the promise to them that this thing's going to be sold in 6 months and your underlying loan will be paid off. As a seller, I don't know why a seller would agree to it. You are at risk for that loan. You can set it up and have a servicer collect those payments and make them so that you would be aware. You would be aware if the buyer missed a payment or was late with the payment, and you could make the payment for them and not screw up your credit. But there's huge risk as a seller. I just don't see it happening a lot. I do know an investor who has personally had the due on sale clause called, and it was with a local community bank. They were doing exactly what I said. They were tracking title changes, and they saw the change. They called up and they said, hey, we don't know who you are, and you currently own the home that we have a loan on. He goes, oh, it's no big deal. The guy was $20,000 behind. We brought it current. Everything's great. You guys are in a better position. We'll just make your payments every month. And the bank said, no, we just have a policy that we will always call it due. And the guy said, well, I don't understand why. He goes, well, my dad started this bank 60 years ago. I'm the president now, and it's always been our policy. And they did literally call it due on sale. And they came up with another even more creative financing way around that, which the bank suggested to them. But in the scope of this, subject to is crazy for a seller. You're just on the hook and in a relationship with that person for the remainder of them having that loan. And if rates never get back down to 2.75 or 3.5, they're never going to pay that loan off. They're going to ride it until the end.
But who wins in that situation? The buyer, right? So if you can get a seller to accept that, go for it. I mean, it's like, to me, it's like the people that are out there at the moment waiting on the big foreclosure drop in housing. Are there going to be foreclosures? Sure, they're going to be foreclosures. Is it going to be, 50% of the market? No, it's not. I mean, right now, foreclosures aren't really having any real uptick at all. In fact, the only ones that are actually foreclosing are people that were delinquent prior to the pandemic. We're talking 3 years ago. And on top of that, foreclosures, I don't know about your market, Todd, but they take minimum 6 months, a year for these things to actually happen and go through. So somebody that's, 30-day delinquencies, actually 90-day delinquencies actually are down from previous months. So we got less delinquencies 90-day happening. So you're talking months out who knows what the market's at that time. Subject to is the same thing. If you see an opportunity that's subject to and you know it can happen, great. Focus some time and energy on it. But I wouldn't be out there that being my only thing that I'm trying to do, trying to get housing, because there's a good chance it doesn't happen for obvious reasons.
I could tell you, Jeb, the active listings in Maryland are about that aren't, they're not impending or, any type of under contract, are about 14,170 plus or minus a couple. 13 in foreclosure.
Yeah. So I mean,
13.
1-3, not 13,000. 1-3.
1-3. 13 in foreclosure. Now, including foreclosures, HUD owned and bank owned properties, about 5% of those. So 712 active bank owned, including the 13, of course.
Yeah,
so about 700 that are bank owned. And then interestingly enough, here's a good stat for you. Short sales, we have about 152 active advertised potential short sale listings. And these are all residential, by the way.
And so in my market, we have, let's see here. We've got, I've got to look at a screen over here. So REOs, properties that are owned by the bank at the moment. So short sales, we only have 2, by the way. So next to nothing there. And this is out of 3,600 active listings on the market in a county where there's 3.3 million people. Real estate owned, which that is properties that are foreclosed upon, there's 4. And then notice the default means they're behind on their payments, not yet foreclosed upon. There's 8. So between all distressed sales, you've got 12 properties, 14 properties on the market out of 3,600 that are active. So I don't know the percentage there, but it's not very high. Yeah. So why am I here? 3, ask about experts from North Carolina. Yes, I will make that a priority. Just because I'm from there and came out of there a couple of weeks ago talking to agents in that market. So we'll make it a priority to do that. Al's asking, are banks still offering portfolio loans, Josh?
Absolutely.
And what is a portfolio loan for those that don't know?
Portfolio loan is basically a loan that a lender is going to keep in their portfolio, so they can set their own interest rates. They can set their own guidelines as long as it meets the federal laws. So are there some lenders that have backed out of this space? Yes. I know of some credit unions that are not doing their portfolio loans. They'll still originate Fannie Freddie loans that they can sell, but not loans they're keeping in their portfolio. But for the most part, everything's status quo there. If we were to see a big downturn in values, you might see requirements change in terms of larger down payments on portfolio loans. For us, my number one portfolio lender offers better rates than Fannie and Freddie. We can do 3% down up to $1 million in the 8 Southern California counties. So they're definitely out there. They're going to vary from lender to lender, and some may have backed out of the market, but most are still happily lending.
All right. Let's see. Josh, what do we got going on here? Let's get some questions where we can get some more people involved.
Just a quick follow-up on the subject to. Flash of Light says, hide the subject to in a trust or LLC. If the owner of the home doesn't have a beneficial interest in the trust, still triggers the due on sale clause. LLC will always trigger the due on sale clause. The only carve out that doesn't trigger a due on sale clause is a living trust. You could make an argument that if you have the beneficial interest in another type of trust, that it wouldn't trigger it, but any change in title is going to get the attention of the lender. It becomes a question of, do they care? I would rather do it openly and notoriously that it is now in Josh Lewis's name and make my payments on time and deal with it. They're not likely to call it due, but neither of those strategies are likely to change that.
Good stuff. Big G, who based on the map here, looks like he's out in your market somewhere. Todd says, I'd love to hear commentary on Arlington, Virginia. Since Amazon headquarters 2 moved in, I've seen teardown sell for $950. So are you familiar with Arlington market there, Todd?
I mean, it's all Northern Virginia. It's the other side of DC, but no, I mean, we don't do anything. We're not licensed in Virginia, but it's very expensive. I mean, it definitely, it's a high dollar market.
Got it. So yeah, unfortunately,
doesn't surprise me.
Yeah. So, I mean, at this point, it's Todd is trying to stay local to his market there. We got a stream here. So unfortunately, the service I use here, I wasn't familiar with. They've updated it since the last time I used it. So a lot of you that let me know where you were from, it wasn't actually going at that point. But you can kind of see here where people are located. Some on the East Coast, some on the West Coast there, some up in Northern California. We got one in your market, one up in New Jersey. Or no, that is your market there. North Carolina and Florida, and then there. And there was a bunch of other people that answered, but unfortunately it didn't come up because I didn't know what I was doing. Imagine that. So
cool,
here we are. So Josh, here, this will be a good one for everybody. Josh, Jeb, we'll even ask Todd this. Do either of you have buyer clients who are being unreasonable about making low offers or have been outbid recently? So I'm not sure I understand the question entirely, but I guess I take it more as, do I have buyers that want to make unreasonable offers that are much lower than what the asking price is? Is that way you guys read it, or do you read it differently than that?
Just
how I read it.
Unreasonable to me is it likely to get accepted or not? And some of that comes down to, we also have unreasonable sellers. The buyer may be completely reasonable with some of the ugly distressed properties that we were talking about earlier, but when we have an inflection point in the market, we went from a super hot seller's market to a market that is not a hot seller's market. Sellers are having a hard time adjusting that. So that unreasonable varies where we're at in the market.
Is that a political statement from Al Bundy, Josh, that the Al Bundy 2024?
He'll be running for president?
I don't know. It looks to me that that's the case. So we'll see. We'll see here really soon. Todd, do you have clients that buyer side that want to make? What do you do? I guess this is a better question. So Al, we're going to change your question entirely. Sorry, but you
Editing.
Todd, we're editing your question. What do you do with buyers who want to make an offer significantly lower than the asking price when you in your head, Todd, know that's an unreasonable offer? There's no way the seller's gonna accept that, or maybe you don't think that. I don't know. But what do you do in those cases where somebody you feel like is being almost unrealistic with regards to how they want to approach a property?
Well, I think the big thing now, and we're just talking about representing buyers at this point, right?
Yep.
So,
Yep.
I think with anybody looking to buy right now, we're having a conversation about just how prepared they are to buy. And through that process, we're finding out just how realistic they are, So, what are they willing to do? What type of loan can they get? Can they, if they're, wanting to lowball a house, is it justified, right? If they're looking at a $450,000 house and they want to offer them $225,000, we're not there yet, right? Not saying that it won't ever be there, but I think it's a matter of, looking at the property specific, understanding whether the property is priced at today's price, right? I mean, I don't know what it's going to be in 6 months from now, but if they're eager to buy, we need to have a serious conversation about some type of a range. So I'm hoping that I've done my part in preparing the buyer to go look for houses.
But
and then
what if
I
you
think,
haven't? Not to say that
I
you
don't think
haven't
I'm
done
taking
your
them
job.
out. Yeah.
But what if they are insistent on making an offer that's much lower than what you think is reasonable? Is an offer you right?
So I'm working for my client, but I think it's more of a question is, will I work for that person, right? That buyer. I mean, they have an opportunity to interview agents. We also have the opportunity to interview clients. And I'm not trying to be smart when I say that. And I want my buyers to win, right? I'm not saying that we're not going to fight and we're not going to negotiate very, very hard. But I think the word is unreasonable here. If I have a reasonable, buyer, then we're moving forward. We're negotiating. We're going to try and get everything that we can, the best price. We're going to try and get the price that we hope it will be 3 months from now today, right? But at the same point in time, the key here for me is unreasonable. If they're unreasonable people, I'm probably not their agent.
That's fair. No, I think that was a good explanation. Yeah, well said. Let's see here.
You have a super chat, Jeb.
Do we? Sorry, I got got caught up here in the craziness of this chat here. Where the hell is it? Oh, there we go. I can't click on it for some reason. Click on it.
That's
there.
weird. It's
Here we go. There we go. Real estate mindset, $10 for Sachs and those absolutely brilliant production scenes you guys
Travis.
created. So
Thanks,
thank
Travis.
you. Thank you for the super chat there. Let's see what else we got here. Josh, somebody says, did the house without a kitchen ever sell? Oh, the one that we were talking about, Josh, the one that we posted the picture of. Did that ever go into contract? Did you look?
I didn't look. I would be surprised if it did, but it sure could.
Be surprised if it did or didn't.
Did.
I think it could have if they were reasonable again on their price.
That's what I'm saying. They based off what they listed it for, I don't think they were ready yet. The market's going to need to soften them up a little bit before they get realistic on that price.
No, Todd, in short, we showed a property here locally last week that was completely overpriced. And then you look at the photos of the inside of it, and essentially it was more or less a flip. I mean, it was completely distressed on the interior, and they were trying to get like top dollar for it. So we were making fun of it.
There was the fun part about it is Open Door had one in the same neighborhood that they had flipped a very bad job, and they were asking basically the same price with new kitchen, new bath. It wasn't a nice kitchen and bath, but at least they were in the house.
What's worse? A bad flip or something that needs to be flipped?
Yeah, we said we would rather have the vacant one, but you got to give me the price that I can actually afford to put the stuff in.
No, good. Three putt bogeys says, how many people are selling out of their low rate? So at the moment, I'm not seeing a lot of it, right? Because I mean, quite frankly, the number of listings on the market selling are down considerably. The only people I'm seeing selling at the moment are people that need to sell for one reason or the other. Like the offer I mentioned earlier was an investor selling. I don't know his situation, but he was looking to liquidate quickly. I just had one that I closed that was a probate sell. Father had passed away. Son inherited the property. He ended up selling that property. The big one that I was talking about earlier, over $2 million. Her husband passed away. She's older. She lived in the house for 59 years. She's selling because, she no longer needs this big house, and she's relocating to the East Coast. So yeah, I mean, it's a mix of everybody. I don't have the people that are owner occupied properties just putting on their properties on the market looking to get rid of them at the moment. In fact, those aren't any of the conversations I've really had. Todd, are you seeing people? I mean, who are your sellers right now? Are they people that are stressed? Are they people that need to sell for one reason or another?
I think they're the only ones selling right now. I mean, if they're not stressed out about and needing to sell, they're staying put. Right. I do have something though that kind of goes along the lines of this, and Josh, you're going to appreciate this. You were talking about, your borrower that was saying, "Hey, look, if I back out of this deal, how much do I owe you for the appraisal?" We had a situation where a deal fell through, and I was the listing agent, and the people came. We had an open house, we had a launch. They came in hot and heavy, overbid the property. And they had a house to sell and that had a mortgage. And so probably one of these low rate mortgages. And I was at the open house, and they were talking with me, and they're like, yeah, well, we really like it. They came back a second time. It was a 2-day open house. And they said, would your seller be open to a conversation about us selling our house first? We want to downsize and move into this house. I said, well, hey, present it. I mean, I don't make the decisions. And so I just encouraged them to do so. So all of a sudden I get a call from the agent, and they said, hey, I've got an offer coming. You're going to love it. And they thought that they needed to sell their house, but their loan officer said that they could buy two, right? That they could still afford the second house. And then we're going to put the house on the market. It's like, great. So we get the offer. It's really good. And they did have a home inspection. So we went for it, right? The seller said, hey, let's take it. So 3 days later, so we have the fourth day is the inspection. 3 days later, the buyer's agent calls me up and says, oh man, I hate to do this to you, but I have really bad news. I said, you do? She said, yeah. She said, they're not comfortable buying the second house, and they're their loan officer said, well, if they're not comfortable doing it, they no longer qualify. And so they're going to exercise their financing contingency and back out of the deal. I'm like, is this a joke? I mean, they just got up and didn't feel like they could afford the second house now, right? But anyway, so what had happened was there were 2 homes that went on the market in that buyer's market, right? They had to sell their house. And the houses went on the market for, it was said to be a lot lower than what they were willing to take. And they just panicked, right? But they backed out. But to the point here, not that it has anything to do with this question, but I've been thinking about this, Josh, and your comment with your, borrower that wants to back out and pay you $700 for an appraisal. What do you think? I mean, would you just arbitrarily say, well, because the borrowers aren't comfortable with 2 houses, does that negate their financing contingency?
From our end, I've had people ask, well, can you give us something in writing that says we don't qualify for the loan? Say, well, I would be lying if I said that. You qualify for the loan and I have your loan approval sitting right here. So how could I in good faith tell you in writing that you don't qualify for the loan? If you qualify for them, you qualify for them. You're going to need to find some other type of contingency. And at that point, clearly we would be risking losing a client, but I'm not going to lie for you. I'm not going to lie to the listing agent when we're trying to get an offer accepted. And I'm not going to lie to them to get your money back. If I would do that, I would expect you probably wouldn't want to continue working with me, because what am I lying to you about?
Josh, I asked the same question about getting it in writing from the lender, and the agent said, well, look, we have the inspection tomorrow, so we'll just get out of it then.
No, and that's the thing. It's you can choose to arbitrate, mediate, go to court, whatever, but the reality is you're just wasting time, because there's going to be an out if especially in the current environment. You can in California, you don't even have to have you don't even have to use a contingency during the 17-day contingency period. Todd, quite frankly, you can just say, I changed my mind. Like, wow, that's, I mean, could somebody say, no, I need an actual contingency? Sure. But the reality is we know that you can use anything that you have. So the fact that you change your mind is good enough, and we all move on. So,
which to my point is, do contracts mean anything anymore?
Well, yeah, I think once you get past the contingency period, they do. I mean, here in California, like during the height of the market, even now, like I just made an offer on a property, I don't know, a week ago that was within 10 days. It was a 30-day escrow. Within 10 days, we'd release all contingencies. So after day 10, essentially their deposit is at risk, right? We don't have the financing contingency that goes the entire time. We're day 10. In fact, that one, we waived the appraisal and the loan on it. So we only had, the other contingencies in place to start. So here in California, it's a litigious state to begin with. When you buy a house, you got to fill out like 30 disclosures just to get it, go through an offer process. But yeah.
Let me ask you a question, because if your agent is not on their game, you as a seller, if your agent is not on their game, they can open up that window longer in terms of not giving a notice to perform, not calling them on that. What do you as a listing agent have to do to protect your seller from someone dragging that window out and getting much closer to closing after their 14, 17 day, 21 day contingency window?
I mean, I think I understand the question, but I mean, as a listing agent, I'm trying to get the buyer to shorten the contingencies as much as possible, even in a market right now where things are sitting a little bit longer, just because, I want to get my seller certainty sooner rather than later. And there's never any certainty. Even after they've released contingencies, there's no certainty, but the probability is much, much higher of somebody not backing out, because there's money at risk for, deposit and all of that stuff at that point that essentially they would lose. So I'm trying to get to that day as soon as possible. So we're asking for shorter contingencies to make that happen. Now, I'm not the agent that will, here our contracts read, Todd, that within 48 hours per the contract, you have to send a notice to perform. Otherwise, you can't cancel. So even if you get to day 17 and contingencies are supposed to be released, if the buyer doesn't release them, you can't just cancel the contract, right? You have to then send a notice to perform, and that gives them 48 hours to comply, at which point they don't comply, then you can back out of the contract, right? So there are some agents that on day 15, 48 hours prior to that 5 p.m. cutoff on day 17, they'll send the notice to perform out 2 days before to make it coincide with the expiration of the contingency date to really make you, you're either releasing on day 17 or there's a potential that we back out. So I'm not that guy. It's more of a communication thing, like trying to figure out what's going on. Are we going to make this happen? Are we not? And let's be open. But at which point I don't feel right about it, we're sending a notice to perform out to make sure that, hey, listen, we're protecting the seller just in case this doesn't move forward. But at the end of the day, we don't want to drag things on.
Well, the issue is the sellers, they don't want it to back. They don't want to back out.
They
right?
absolutely
I mean,
don't.
so, that buyer's agent, maybe it's the buyer's agent probably in these cases, right? I mean, the buyers aren't the ones saying, don't we need to get this over? I mean, it's the agents that should be responsible for marking their calendars and getting the alerts to, hey, I need this by this date or this by that date. But, I'll give you an example. I mean, I've seen where, settlement's going to be delayed and it's the buyer's fault. And you're like, okay, I need an extension. You're saying to the buyer's agent, like, I need an extension. We're going to be out of contract at midnight, right? If we don't settle today, we're out of contract. And they're like, oh yeah, well, I'll get it to you. And then you don't get the extension until 24 hours after it expired. And they're like, no big deal, right? What are you going to do? I mean, is the seller going to kick them to the curb at that point? Because, we're at the finish line and the agent just doesn't comply with the dates. So, I mean, we're just seeing, Jeb, it's been the Wild West and, it continues to be the Wild West and, anything goes kind of thing. And to your point, where it's a professionals market and a buyer or seller should be interviewing agents and making sure that they have good agents.
No, agreed. An hour and a half into this, asking, we're going to cover half of Todd's head up there by putting a banner at the bottom.
Todd's hiding.
Yeah, Todd. If you just duck down, dude, you're gone. Listen, if you found any value tonight at all, hit that thumbs up. Follow me on social media. Josh's stuff's not on there. If you follow me on social media, you had the opportunity this last weekend to see me dress up like Travis Barker, cover my body in tattoos. It took 2 hours, people, 2 hours of standing there, putting little tattoos all over me to become Travis Barker, my wife's wild idea. And it took about 3 days to get them all off. I think as of today, I'm completely.
Are you tattoo free now?
I'm tattoo free today.
She could have had you as like Mrs. Doubtfire or something. So, I mean, maybe you ought to be grateful, for small tattoos.
That I was Travis Barker instead. But anyhow, we do appreciate the support and you guys being here. So for those of you just jumping on, Todd Sachs, has a YouTube channel. Check it out. Sachs Realty is the channel. Information's in the description below. You can find him there as well. But he's on the East Coast in the Baltimore, Maryland area, Northern Virginia, DC, all that market. So if you're looking for a pro in that market, you can find him there.
Jeb, we had a couple of questions that are on a similar topic here. So Heidi LaFleche says, comment on shoddy flips. I've looked at a couple and it's frustrating, sloppy work and cheap materials in what could have been decent houses. Do you ever advise clients to bid low and redo the work? Having flipped a bunch of houses, this one's near and dear to my heart. I hate seeing a home that was distressed, needed a bunch of work, and an idiot goes in and does a terrible job of it and then wants a bunch of money for it. When we came in heavy in 2008, 2009, 2010, it was the type of market where people were buying homes, but they wanted to buy the really nice ones. So you needed to fix them nice and they were going to get an inspection. They were going to ask you about it. Now, as the market transitioned through 15, 16, 17, 18, and into the pandemic and the power transition to sellers, there were a lot of flippers here in Southern California doing the most horrific half-ass jobs on these rehabs and then expecting you to pay through the nose for it. What do you guys do and how do you advise your clients who want an updated flipped home and you're looking at it going, God, this work is awful?
I mean, here's what I see. So I about 3 or 4 months ago closed on a property for some buyers that were actually moved out from DC and bought a house here in Huntington Beach, and it was a flip. And we're talking a price of $1,450,000, and it's a good neighborhood, nice house, and pictures look great. Flip was done very well in the pictures. You get in the property, I picked it apart, right? There's just that they did a good job on the design, but the details weren't there, right? There were just things missing and just things not done correctly. We negotiated a repair request, not to have them do it, but money towards a credit for them to go in. Now, these weren't big, huge problems that would have you completely redo the property. These were more things that, hey, listen, you get a good handyman in there, you spend some time, you're handy yourself, and you can do it relatively inexpensively. So in that case, we negotiated a credit to do it. But I would say when you get into these really big remodels or a property flipped and they've done a crappy job on everything, I don't think there's an amount, in my opinion, to get a credit for to go redo that work, because you just don't know where it stops. Like, what didn't they do behind the walls? In this case, there was a subfloor in this property, so we could actually get underneath the house. A lot of the houses here in Southern California are on slab foundations, and you don't know what the plumbing is. You don't know some of the situation. Here, we know inspector was able to go underneath and see all of that, and all of that was done correctly and done well. And so, in some of the newer systems of the house, or some of the systems of the house were newer, so we knew there weren't any issues there. But some of these properties, they go in and they just do crappy work and try to make sense of it by putting lipstick on a pig. And the reality is, and they're trying to profit hugely. And I think that's a waste of time personally. I think there's a better opportunity to go find a similar property that hasn't had the work done and make a lower offer on that property and get that for a better deal in that market, because those people know what they have versus the person that has the flip. They still think they have something great, even though it's not in many cases.
And we've talked about that before. 2 years ago, I would suggest not buying a fixer, because people would buy a fixer at a 15% discount to the market and think they were getting a deal, but it took 20% of the cost of work to do it in a market where contractors are all slammed, materials are through the roof. To get that nice house, you end up paying more. We are now transitioning into a market where you can get a discount. We're just talking about what's sitting on the market, the ugly houses. So it would definitely make more sense for me as a homeowner, not a contractor. If you're walking through and noticing visual problems with the work that was done, it's 10 times worse behind the walls and things that you can't see. If they cut corners on things you can see, they're massively cutting corners on the back end.
Good stuff.
Yeah, and I can add to that too, because I flipped a bunch of houses, and as a contractor, we really haven't been in a flipper's market for the last couple of years. So if you're looking at a flip right now, it's really important to know, what did they pay for it? Because just like both of you guys have mentioned, people think that they're getting a fully rehabbed or renovated house, and essentially that they're buying a new house, and they're not. And depending on what was done, you could really be in a worse position financially, if things were done incorrectly. And when I'm looking at houses that have been flipped, we're really diving deep to make sure the product.
Now with that said, Todd, are you, I'm going to kind of backtrack here a moment. Are you seeing any opportunities in your market at the moment for potential flip opportunities, or prices still not where they need to be in order to make these work?
They're just not there. I'm seeing that the flippers, the ones that are buying houses to flip right now, are really first timers. They have no idea what they're getting themselves into. And they think, and I did the same thing. Look, when I first started out, 25 years ago, when I flipped my first house, I thought, it's great. I'm going to buy this house and I'm going to rehab it the way that I would like to see it. And then I'm just going to put it on the market and sell it for whatever I need to sell it for to make a profit. It sounds like I'm an idiot, right? I didn't consider myself as an idiot. I just didn't understand that you make your money flipping on the purchase side of things, right? Not what the finished product, because the market is going to dictate the price.
Right.
And so I think that, depending on what the property needs. Now, guys, I'll tell you, when I flipped houses, I had a habit, like I had a partner for 10 years flipping houses. And, I was known as the guy that took a perfectly good house and tore it down, because I would literally go in to a house that I'd say, hey, we'll renovate this house. And I'd go in and be like, it's not worth it. And I would literally tear the whole thing down to the studs and rebuild the whole thing. Because when you get into flipping houses, people don't realize you're always going to find something more than what you expected. The question is, are you going to cover it up or are you going to deal with it? And a lot of times dealing with it means that you've lost your profit. So, I haven't seen a flippers market, Josh, when we were talking about distressed properties selling for 50% discount back in 2008, 2009, and so forth. I mean, yeah, I was buying houses, in the county around Baltimore, $45,000, $50,000. Now those like condition houses are 220.
Right. No. And you said something profound there for people that didn't hear it or not listening and whatever. And that's if you're a flipper or an investor looking to get a deal on a property and try to sell it, you make your money on the purchase of that property. So if you're looking at properties on the MLS, you're looking in the wrong place. You need to be finding those properties off market.
And it's the food chain, right? So if you look at, flippers are at the bottom of the food chain. They need the most profit, right? And then at that, when we're looking at house sales, the flippers have to pay the least. Then comes the buy and hold guys, right? Because they're going to go off appreciation. Maybe they need to enhance the property, but they can pay more than the flippers because they're going to keep it and they're going to rent it and they're going to turn it into passive income, right? And then you have the people that are going to live in the house and they'll ultimately pay the most. And we know that, right? But so I think that just the market has dictated that, if you're not buying at a distressed price or getting a really super good deal on it, you can't flip it.
Well, hey, we actually just had an awesome follow-up question pop up here, and this relates back to what we talked about earlier in the show. Rich D says, I'm in the middle of a renovation of my own house, prepared to sell in the spring. I figure it's just going to get it up to par, not a premium. If you had a seller who wants to bring their house on the market in the spring and they do want to update and renovate, what do you think about this strategy? Is it just to make it clean and nice and presentable, or would you tell them, I think you probably should make it as nice as possible so that you're top of the food chain with homes that are on the market in the spring?
I don't think that's an easy question to answer, Josh, without knowing the property, the market, all of that stuff. I mean, I think here's the reality. We came out of a market where people were putting homes on the market. I would walk into a property and it looked like garbage. I can think of several in my head as I'm having this conversation right now that when I went in, they said, what do I need to do? And I said, absolutely nothing. We're going to sell it the first weekend. It comes on. Probably going to get multiple offers. It's going to sell above the asking price. We don't need to do anything. And it wouldn't have mattered. We could have painted. It would have been the same situation, right? We could have replaced the flooring. Same situation. It's going to go up above the asking price. It's going to sell for more than it should. Right now, if I walk into a house that needs that, I'm saying, you need to paint. You need to do the flooring. You need to declutter. You need to do the things that you needed to do prior to the pandemic to get it sold. Now, I don't believe that you have to go in and completely upgrade it, do the kitchen, quartz countertops, white cabinets, whatever. And in this market necessarily to get it sold, will that maybe get a couple more buyers? It might, but it's going to cost you quite a bit more money to do it. I think at the end of the day, it comes down to price. So if we say, hey, listen, you spend $50,000 remodeling this kitchen, are you going to get $50,000 more? I can't tell you, right? I mean, we don't know because of the market or what's happening with rates if the buyer is going to come in and do that. So I think you spend the least amount of money to get it in the best condition possible based on the comps around it, and then try to justify it with putting it on at the right price.
And it's all relative. We all look at things through our own lens. Having flipped a bunch of houses, I know doing a middle of the road to a significantly nicer flip is not that big of a difference. I'm not talking premium like luxury home level stuff, but if you want entry level oak cabinets versus ready to assemble, made in China, nice shaker cabinets. I mean, they're not custom, not home built custom built cabinets, but they're still really nice. It's not that big of a difference. So I go into homes and I go, what did the flipper save here? Like, a crappy closet door, sliding closet door is $100. A good one is $200. Was $100 that important? I can look at it and know you cut this corner. What other corners have you cut? So I'm not saying make it a custom home, but I'm saying there are custom flourishes that you can do that are not that expensive that will make a big difference. Because like we talked about earlier in the show, for us here in Southern California, my clients that I see buying throughout California, the stuff that's really nice, they're getting in bidding wars on it. 1, 2, 3 offers on a home and having to pay a premium. The ones that are nice, but a little dated, not so much. And then like we talked about, the crappy ones, not at all. So he's doing the work. It's going to be at least nice and clean, but I think that you're likely to get that return. But you're right. You have to see the property and you have to know the market, but there are some things that are not that much more money that will get you a nice return.
And I think to Jeb's point too, Jeb nailed it. Is it going to make you money? I mean, and we know that in our business as constructive returns, right? So there are things that you have to do to sell, and where you may not get your money back, but you must do it if you want to sell. And then there are things that you like to do that you may not make the money on, and you don't need to do it. And the question is, if you do it, will you make at least your money back, and will that aid in a faster, easier transaction? But Josh, to your point with the flipping, when I was flipping full time, and this was before I was a real estate agent, I had agents that would, I was known with giving a high quality product. There's only, if you're selling in a market, there are a certain amount of agents that you want to know who you are, right? And you want their clients to be satisfied with the product, because I would be able to have, my own brokers open, where I would have, the launch of my property, and I would have agents say, you know what, I have a buyer for this property. And they would say, like, Todd's product is always good. It's reliable. It's a decent house. And so, it's, if you're in it for a business, you don't want to be putting lipstick on a pig.
No, good stuff. Let's see here. What's the difference on rates from well-qualified compared to, say, a mid-tier buyer, Josh?
It can be the difference between which program you're going to go with. For a conventional loan, you probably need to be above a 680 credit score for it to make sense. And the difference between a 680 and a 740, which is the highest tier for Fannie and Freddie as far as their loan level price adjustments, probably talking 0.5% on that. And the reason why we don't often do 620, 630, 640 scores conventional is it can be, a percent and a half difference when you get to the lower tiers of the credit scores. FHA, the tiers are different. VA, the tiers are different. Depending on your investor, FHA and VA doesn't have loan level price adjustments based off credit score, but investors will put them in because they want to keep the weighted average credit score of their mortgage pools to the higher end. So 680 and above will get you the absolute best on an FHA or a VA for the most part. 620 to 640 to get to a good rate. And then below that, you're paying a big premium. So it just depends on the type of loan, but it can be significant, and it can push you from being able to get a conventional loan to having to get an FHA loan, just because the rates will be better at lower credit scores.
There you go. Let's see. Rafi is a regular viewer on here. Says, is there such thing as a loan lock while shopping, like 90 days? And if so, how does that work? So go ahead.
Rafi is not only a longtime viewer. Rafi is a VIP customer, and we just got his loan docs out on his purchase today. So he's not going to benefit from the answer to his question, but his loan doc showed up at escrow, and they're going to be closing here in a couple of weeks and in their new home by Thanksgiving. So the question is, 2 years ago, hardly any lenders were doing a lock and shop because it just wasn't beneficial. Like, it could take people 6-8 months to find a home, and homes were selling so quickly that there wasn't a need, and rates were flat to declining for 3, 4, 5, 6 years prior to that. Most lenders are offering a lock and shop, which basically means you get pre-approved to the loan program, you lock your interest rate up to a certain loan amount that you're qualified for. And once you find a property, we give them the address, and that lock is tied to that. So fairly simple, not really any different than a lock on any other property. The hedging costs are higher to offer that long of a lock and to not have it tied to a specific property. They close at lower rates. So it generally is not going to have quite as good of terms. But as we've seen, Jeb, we had people asking us in the spring, hey, I have a new construction that's going to close in August. Should I lock my rate? Yes, it can be beneficial. We've seen, rates have been relatively flat, although trending up since September. So it hasn't been that big of a benefit. But through the spring, when rates were rocketing up, it was very beneficial.
No, good stuff. Proxy, who's a member of the channel here, says, hey guys, so what do you make of the theory that new homes coming to the market will have a major influence on pricing down existing home sales too? A lot of new homes possibly set to fire sale in coming months. So I think there's some truth to it depending on the market that you're in. If you tell me that's going to bring existing home sales down in my market, I'll tell you it's not, right? We don't have a lot new construction, right? By the coast, densely populated areas, all new construction is infill properties. In fact, I look at some of these new construction properties that are in my market, right? We have like a little infill development right around the corner from here. Townhomes, there's like 30 of them in this little development. And I saw the price at which these things come on the market, and I was like shocked. I'm like, oh my God, if that thing even sells close to where it's at, I mean, it sells $200,000 under the asking price, I feel like it's still overpriced just based on the location there. So can it? Sure. Will it? Some areas, absolutely. I think it all depends. I mean, what I can tell you is I just did a video on new construction. It's going to come out probably next week sometime. But at the moment, there's only 1.1 months of supply of actually constructed homes that are actually constructed on the market, ready to be sold. When you hear 9 months of supply, what they're accounting for that is that, 6 months of that supply that they're talking about, there are homes that are under construction that are in the process of being built. And then you have like 2% of homes on top of that have permits pulled. So they count all of those as well. The homes that are going to be most impacted are that 6 months that are kind of in that middle there. They're in the tier of being constructed at the moment, because depending on when those are done, what area they're in, those will have a bigger impact on the local markets there, because if rates continue to go up, if rates stay the same, we're headed into the slower time of the year, those are going to have an impact. Now, keep in mind at the same time, not all of them are going to come to the market at the same time. Not all of them are going to be, in the same area. So it's going to be a relative, equation, if you will. But if you're in a market that has a lot of new inventory, then you might expect those to be your better opportunities. I mean, what will it impact existing home sales? Yeah, but there's an opportunity on those properties more so than anything else, because these contractors, these builders want to probably get rid of them because of more supply coming, because of the market in general. I see, an opportunity, especially for the person that's going to be holding on to the property long term. Anything?
Yeah,
Nope.
I think that we have a lot of new construction here in Maryland, and I think they're going to get hit the hardest. They were hit the hardest back in the '08 crisis. I think they're going to be hit the hardest now. You said it, Jeb. These people need to. These companies need to sell their houses. They have a carrying cost, and every day it becomes more expensive. A lot of these builders are in subdivisions where they've been building for 3 or 4 years or more, and they've dedicated a lot of the finished roads, finished streets to the homeowners association. So they're paying HOA dues. They're paying a lot of money. And what we're seeing here locally is a lot of the builders are flipping their home sales to home rentals. We have a local builder, a pretty big one actually, that he did that all through the last downturn, and we're seeing a lot of builders now liquidating their lots to other scattered lot builders. So we're getting smaller builders are capitalizing on the fact that these subdivisions have been developed from an infrastructure standpoint, so that and the builders are just liquidating lots. So I think it's a rough road ahead. Building prices are outrageous. Labor is limited. Skilled labor costs are high to build these houses. I don't think it's going to affect the existing home market, at least locally here. I think if anything, it will strengthen the existing home market, because the existing home sellers, for many of them, they don't need to sell, and we're already looking at extremely low inventory.
No, good stuff. Simon gave us a $10 super chat here. I'm going to throw this one your way, Todd. Just says, any guess as to why an investor would do sight unseen offer with feasibility contingency, but not inspection access? The offer explicitly says they will not have access. I'll ask my agent tomorrow. So I'm not even sure I understand the question entirely. So if you understand it, maybe you can give your
So a feasibility contingency, a lot of times when you're looking at that, you're looking at what else can be done with the property. So let's just say it is a residential house, but maybe there's some commercial aspect to it, or maybe the lot can be subdivided into additional parcels. So a feasibility is really sort of like, I need, 90 days to figure it out. So I'm going to put an offer in, I'm going to put it under contract with the price that I'm willing to pay, knowing what I know now in hopes to what I could make this property later. And then all of that is still up for future negotiations. And we saw this a lot with bank-owned property where the seller was still in the house, even, or the not seller was in the house, but the prior owner was in the house. Now it's bank-owned, and they're saying, hey, look, you have to buy the property, but you can't go on the property. It's unlawful to go on the property. So I bought quite a few properties like that based on this same thing. Well, hey, look, if I can get in, I'm looking at the property, not of what the person living there has done to the inside of this place, because maybe I'm going to tear it down anyway. So I think that, is really more of what we're probably
that's good
about.
Because I had no idea, and that makes perfect sense to me. So I could see why they would do the contingency, not needing access. And so good. Josh, were you going to add something there?
No, just basically the same thing. They probably have a specific use, something they want to do to the property, and want to make sure they can do that before they go through with closing on it.
No, good stuff. So guys, we've been on almost 2 hours. I want to thank Todd for being here. Todd Sachs Realty is the YouTube channel. Go check him out on there. Get more information on the market in general, what's happening in his market. I know he streams at least once a week, does some other videos on top of that. So check him out. Appreciate you being here. Guys, hit the thumbs up. Follow us on The Educated Home Buyer as well. It's a podcast, Todd. You probably don't even know about that. It's separate from the show. We do a deep dive into real estate topics. In fact, the one that it got published this week are the opportunities that are in the market right now. Where are those opportunities? We publish every Tuesday. And then actually we take this podcast. So Todd, if you want to share a podcast
you're going to be on the podcast.
Yeah,
Todd,
you're going to be
like
on the podcast, because we actually take this live stream and turn it into audio format for the podcast every Friday. So if you want to listen to yourself, Todd, while you're working out and you really want to get motivated, you can do that by listening to The Educated Home Buyer.
That guy's awesome.
Right. Yeah. If I want to learn something from myself.
Yeah, there you go, man. But we appreciate your time and being here, and take an opportunity and say anything you'd like.
Guys, I appreciate it. Thank you so much for having me on the show. I love what you guys are doing, and it's such great value to your listeners. And cruise on over if you guys want to check us out, and we'd love to see you on our channel. So, and Jeb, we'll do it. Josh, we'll have to reciprocate, do another collab with you guys. We've done 2 of them with Jeb. If you'd like to check out those videos, it was a different market, a different time, but still very good information. And you guys are pros. Thanks so much.
No, absolutely. And Josh, any final words?
No, other than just continue to educate yourself and come to your own conclusions. We come here every week not to tell you what to do, but you wouldn't be here if you weren't interested in housing. So get the information that you need, get educated on your market. The mortgage stuff is pretty consistent across the country. There's some regional differences and local product options, but the real estate stuff is very location specific. Get with a known expert in your area that can advise you so that you can make the best decisions possible.
And lastly, if you want to get in touch with an agent, with a real estate agent, mortgage professional anywhere in the United States, you can check out that link that's scrolling across the bottom there. Happy to refer you to a professional like Todd in his market or any other market you're looking. And if you need a quote on a rate, want to compare it, we have professionals all across the U.S. that are happy to help there. So that link will get you there. But for now, we appreciate you listening. We appreciate all the support. We will see you.